Management accounting is an important part of running a successful business. It provides an organization with the information it needs to make informed decisions, plan for the future, and measure performance. This guide will provide you with an overview of the principles and best practices associated with management accounting. The first step in effective management accounting is to understand what your organization's goals are and how you can use accounting to achieve them. Once you have identified these goals, you can begin to set up a system that will help you track progress towards them. This system will typically involve setting up accounts for each relevant element of your business, such as sales, expenses, and assets. These accounts should be regularly reviewed to ensure accuracy, and accuracy is essential when it comes to management accounting. In addition to setting up accounts, there are several other important elements associated with management accounting. Accurate financial reporting is key in order for organizations to make sound decisions based on their financial data. Accurate reports also allow organizations to identify areas of needed improvement or potential opportunities for growth or expansion. Additionally, periodic analysis of financial data allows organizations to compare their performance against other similar organizations in order to benchmark their success or identify weaknesses that need addressing. The next key element of management accounting is budgeting and forecasting. This involves creating budgets based on anticipated expenses and income projections while taking into account external market factors that may affect the organization's performance over time. Budgets can be established both short-term as well as long-term in order to ensure that sufficient funds are available when needed while still leaving room for flexibility when necessary. Additionally, this process should be regularly monitored so that any changes in market conditions can be accounted for and addressed through appropriate adjustments in the budgeting process. Finally, one of the most important elements of effective management accounting is internal control systems designed to prevent fraud or error from occurring within an organization's financial systems. Internal control systems typically involve setting up procedures or protocols designed specifically for a given area or process within an organization, such as cash receipts processing or payroll processing. Additionally, internal control systems should also include regular monitoring activities designed to identify any irregularities or issues which could lead to problems down the line if not addressed properly. Overall, management accounting is essential for any successful business, and understanding the principles associated with it is key in ensuring its effectiveness moving forward. Properly managing an organization's finances requires a comprehensive approach which includes accurate account setup and maintenance along with budgeting and forecasting processes, as well as internal control systems designed specifically for each area within your organization's operations. With these steps in place, you can ensure that your business's finances are managed effectively now and into the future. Management accounting is an essential part of any business, providing financial information and analysis to help guide decision-making. It is used by businesses to determine how resources are allocated, manage budgets, track and control costs, and provide financial advice. It can also provide insights into potential risks and opportunities for the organization. At its core, management accounting involves a variety of concepts that can help guide business decisions. The following are some of the most important concepts involved in this type of accounting. Cost accounting. Cost accounting involves using accounting principles to identify, measure, analyze, and report on costs associated with producing goods or services. Cost analysis is an important factor when determining pricing strategies, as it helps to understand where profits are generated from. It can also be used to identify areas where costs could be reduced or eliminated. Budgeting. Budgeting is the process of setting goals and objectives for a business or organization and then allocating resources according to those goals. A budget helps to ensure that resources are being used efficiently while also helping the organization achieve its financial objectives. Financial planning and forecasting. Financial planning is the process of developing long-term objectives for a business or organization based on current financial data. This includes analyzing current financial position, forecasting future needs, setting goals and objectives, evaluating capital structure and liquidity needs, developing cash flow projections, as well as other related activities. Financial forecasting, on the other hand, involves predicting future trends in order to make informed decisions about investments or operations in the future. Performance measurement. Performance measurement involves analyzing past performance against a predefined set of criteria in order to determine whether objectives have been met or exceeded. This type of measurement can help identify areas where processes need improvement or where resources should be allocated more efficiently. Risk management. Risk management involves identifying potential threats that could affect a business's ability to reach its goals and objectives, as well as developing strategies to mitigate these risks in order to maximize potential profits while minimizing losses. This includes assessing risk exposure levels through detailed analysis of various factors such as market conditions, competitive landscape, regulatory environment, etc., monitoring risk levels over time and taking corrective action when necessary. Decision analysis. Decision analysis is the use of mathematics and statistics tools to understand impacts of different types of decisions made by organizations, ranging from short-term tactical decisions such as pricing strategies all the way up to long-term strategic decisions such as mergers and acquisitions, so that they can make informed choices with confidence regarding their operations going forward. Activity-based costing, ABC. ABC is an important tool used in cost management by assigning costs directly related to activities rather than processes or products, which allows for more accurate cost allocations across different areas of operation, which can then be used for decision-making purposes such as pricing strategies, etc. Additionally, ABC provides insight into overhead costs, which may not be easily visible when using traditional costing methods, thus enabling more efficient resource allocation decisions across organizations. These are just some examples of key management accounting concepts that should be understood by anyone who wishes to manage their business finances effectively. By understanding these concepts, you will be better equipped with the knowledge needed when it comes time for making strategic decisions about your company's finances. Such knowledge will enable you to make sounder decisions that will lead your company towards success. Welcome to the Guide on Management Accounting Formulas. In this tutorial, we will cover the basics of management accounting and provide an overview of the key formulas and calculations used in the field. Management accounting is a crucial part of any successful business. It involves the use of financial information to support decision-making, planning, and cost control decisions. Management accounting also helps businesses analyze their financial performance and plan for future growth. The key formulas used in management accounting include cost volume profit, CVP, analysis, break-even analysis, budgeting, variance analysis, activity-based costing, ABC, standard costing and capital budgeting. Cost volume profit analysis, CVP. Cost volume profit analysis is used to calculate potential profits based on changes in the sales volume, unit price, and unit costs of a product or service. The CVP formula looks like this: total revenue, total cost equals profit. Break-even analysis. Break-even analysis is used to determine how much sales revenue needs to be generated before a business can break even with its expenses. The break-even formula looks like this: fixed cost plus variable cost equals break-even point, BEP. Budgeting. Budgeting is an important part of management accounting that allows businesses to set financial goals in order to achieve desired results. The budgeting formula looks like this: actual revenue, actual expenses equals surplus/deficit, S/D. Variance analysis. Variance analysis is used to compare actual results with expected results in order to identify areas for improvement or further study. The variance analysis formula looks like this: budgeted amount, actual amount equals variance, VAR. Activity-based costing, ABC. Activity-based costing is a system for assigning costs to activities that drive costs within an organization or product line. The ABC formula looks like this: direct costs plus indirect costs equals activity-based cost, ABC. Standard costing. Standard costing is a method that sets predetermined costs for products and services prior to production or delivery so that budgets can be adjusted accordingly during the production process. The standard costing formula looks like this: standard price x standard quantity equals standard cost, SC. Capital budgeting. Capital budgeting is used by businesses when allocating resources for investments such as new equipment or technology upgrades with long-term effects on operations. The capital budgeting formula looks like this: internal rate of return x present value equals net present value, NPV. We hope you found this guide on management accounting formulas helpful in understanding the key concepts behind these calculations and how they are applied in practice within businesses today. Thank you for watching. Welcome to our management accounting salary video. This video will provide you with an overview of the salaries that a management accountant can expect to earn. We will discuss the factors involved in determining salary levels and provide useful tips on how to increase your earning potential. Management accountants are responsible for analyzing data, interpreting financial information, and providing guidance and advice for organizations. They must possess strong analytical skills and be able to work with complex data sets. Management accountants are also expected to use their knowledge of accounting principles and financial analysis techniques to generate financial statements and reports for decision-making purposes. The salary of a management accountant depends on many factors, such as the size and type of company, industry experience, qualifications, location, and job role. Generally speaking, management accountants who work in large companies tend to earn more than those who work in smaller ones. Moreover, those who have relevant certifications or additional qualifications typically command higher salaries than those without them. Location is another major factor in determining the salary of a management accountant. Salaries tend to be higher in larger cities due to higher cost of living expenses, while they may be lower in smaller towns or rural areas where there is less demand for skilled professionals. The industry sector also has an influence on a management accountant's salary. Larger organizations may offer more competitive packages, whereas smaller companies may only be able to offer basic wages. It is important for management accountants to stay up to date with industry trends, so that they can demonstrate their value and expertise when negotiating salary increases or when seeking new job opportunities. Taking courses or training programs related to the profession is one way that management accountants can stay ahead of the competition and increase their earning potential. Additionally, having a good understanding of technology such as data visualization tools can help you stand out from the crowd when it comes time for promotion or salary negotiation discussions within your organization. Management accounting salaries typically range from $50,000 to $80,000 depending on experience levels and job roles. However, those at senior executive level may be able to command higher salaries up into six figures depending on qualifications and other factors discussed earlier in this video. When looking at advertised positions, it is important to note any additional benefits such as bonuses or health insurance packages which could add significantly onto your overall package at no extra cost. We hope this video has given you some insight into what you can expect when looking at potential management accounting roles. Remember that taking steps such as gaining additional qualifications or staying up to date with industry trends can really help boost your earning potential. Thank you for watching our management accounting salary video.